Okay, and now I'm going to also now share with you guys the presentation. Okay, all right, over to you. Second. Okay, over to you, Lucas.
All right, so me and Derek are sophomores at Trinity High School, and this is just a quick investor summary for Somera Road Net Lease Holdco. Quick disclaimer, this is our project, and these are not Somera's words. Somera, we do not represent Somera. So there are four key concepts in this strategy. Number one is scale, which is extremely important in all of industrial real estate. As a portfolio scales, it gains cap rate benefits, interest rate benefits, and LTV benefits. And Somera is able to reach scale and benefit from these through their financing strategy, which they use short-term floating rate debt, which allows them to preserve optionality and allows them to continue to acquire assets and scale their portfolio. This is also achieved through the power of equity recapitalization, which Somera uses to pull out equity and capital from their portfolio, which de-risks, or if they choose to reinvest into more acquisitions, allows them to acquire more properties. And number four, rapid return of capital. I just talked about that in the equity recapitalization, and also just through the cash stream that this strategy produces. And at the at the bottom there, just reiterating this point on scale, it drives cap rates, borrowing costs, and LTVs, which through a levered recap drives high return of and on capital. So Somera's vision. This is a high current tax efficient yield vehicle. Somera is generating high cash on cash yields, mid-teens plus, and high IRRs, 20% plus growth. With a moderate MOIC 2 to 3 times. This is a cash flow strategy, not a MOIC strategy, just to keep that in mind. Going back to what I was saying before on scale, creates massive value in industrial real estate, lowering cap rates, increasing LTV, and lowering interest rates. Somera finances their whole portfolio, at a portfolio level, not an asset level, which gives them interest rate benefits even before they've reached scale. Also, they're likely to continue using short-term floating rate debt even once they've reached scale. So they're currently not planning on terming out the debt to 10-year or whatever, purely because as they continue to grow, long-term fixed rate debt is really inhibitive and too expensive to recapitalize. And contrary to Somera's usual value addition strategies, there is little to no operational value add. Most of the value add is through their financial structure and through their scaling the portfolio, with one exception being a tactical blend and extend strategy, which I'll get into later.
So step one is the initial asset acquisition, and as of now, the current cash and cash returns are not stable. 12 to 14% gross yields that are achieved through first floating rate debt, and second an LTV, which is too low at the moment, means that the returns are not stable but can go up and down. And the first main point of step one is that the assets are mission critical industrial assets of the triple net lease format, which means that they're very valuable because they're very low risk. And the value in these assets comes from the tenant, not the asset, because the tenant, most of the value comes from the income from the rents and not the asset appreciation. Second, the acquisition pricing is fair market value, which means that these properties, or the strategy, is durable because they are not finding extremely cheap properties. And leverage is 65% to 35% debt to equity, or 9.5% net debt to EBITDA, compared to around 6 times net debt to EBITDA for public listed triple net REITs. And assets are financed as a portfolio, as Lucas said, which means that assets can be, or assets are or can be gotten for cheaper because they are less risky. And value creation risk in the short term is from the fact that they're using short-term debt. And finally, in step one, Somera is not taking a view on the yield curve, even though they are using short-term debt. This is only to preserve optionality as they move to step two. And on this graph, the static represents the current value that Somera has if they held for 10 years. And so if the exit cap rate were to change by 5%, shown by the yellow box on the left column, then on the right, we can see that the IRRs and the MOICs do not change by very much. And also, if the interest rate was to increase by 1%, we can still see that the IRR and MOIC, along with year one yield, will decrease moderately, but the main driving factor for value is the LTV. And we can see that if the LTV is increased by 5%, IRRs increase by almost 3%, and year one yield increases by almost 2%. Oh, excellent. We're moving on to the next slide.
And Somera plans on increasing the LTV to 80%, not just 70. So they're gonna reap a much larger reward than it shows in this chart. Oh, and moving on to step two, the actual scaling of the portfolio. This is where most of the value creation happens. So the Somera achieves their diversification benefits once they reach scale, which is around 300 million for the cap rate compression of 50 to 75 basis points, and around 500 million for financing spreads, 20 to 25 basis points, or LTV increases, which they plan on increasing to 80%. Somera also has the option of converting the debt or the assets of this portfolio to a liquid market, which would eliminate the illiquidity premium, which would again compress cap rates and compress interest rates if they chose to do that. Reiterating what Derek was saying before on the importance of the increase of LTV, the three main factors that drive the returns in this step are the same as before: cap rates, LTV, and spread compression, but LTV is the most sensitive one. Once they reach scale and increase the LTV and they get the cap rate compression and spread compressions, Somera has the option for a levered recapitalization, which is where they pull out a bunch of the equity. And this gives them two options to use with the extra equity. They can either dish it out back to the investors, which would like lower risk because there's less of the original invested equity into the fund, or they could reallocate the capital back into the business, into acquisitions or such, and that will affect multiple uninvested capital. If not, it won't affect MOIC, but if it does, it will increase it slightly. Going back to the blend and extend that I mentioned before, this is the only operational value add that Somera has in this strategy. This is when they would look into buying properties at a 5 or 6 year lease term instead of the usual 10 plus, only if they believe that they can extend that that lease term to up to 15 years. And by doing this, they can buy properties, they can buy high quality properties at super cheap prices, low cap rates, purely because there's essentially no competition at that low lease term. Usually companies don't want to touch anything lower than 10 years because a lot of the value in this area comes from lease term length. And finally on the slide, the TAM, roughly 20 billion transacted per year, and in Somera's pipeline already, they've got hundreds of millions under contract or in late stage negotiation. So in this example one chart, all this is showing is is what you would have a portfolio of single assets rather than a portfolio, like a scale portfolio that has been recapped. So as you can see, you get the 50 basis point compression of cap rate, the LTV increases to 80. This is also assuming no interest rate change. And if you look at the bottom there, you'll see 61% of the equity is returned, of the original equity is returned, and the cash yields on that remnant equity is 32.2% as opposed to 14.4% in a portfolio of single assets. In example two, it's the exact same chart, except we assume 100 basis point increase in interest rates, which will drop the cash yields to 25.9%, which is not super substantial. And if we assume a 200 basis point increase, which could potentially happen, the cash yields will drop to around 18-19%, which although it is a hit to the income, the yields are still very attractive. This example three, this is just showing the blend and extend. This is purely an example property. This is not a real one that Somera has. So this is assuming they bought a property at a 7-year lease term with a cap rate of 6.75, and they're able to extend it to 15 years. Purely by doing that, nothing else changing, the cap rate drops to 5.5%, and the equity value, the notional equity, increases from 4.4 to 9.5 million. And once recapitalized, when you get the LTV back to 80%, you can dividend back 4 million to either the investors or to invest it back into the business, as I said before. And if you see the original equity is 4.4 and the dividended back is 4 million, you're essentially getting a very cheap or almost even free property just by extending the year to 15 years.
Okay, so for step 3, which is the industrial portfolio scale, a scale portfolio puts Somera in a strong position to acquire new buildings because it results in a lower equity intensity than would have been required to buy it on a standalone basis. So this means that at scale, additional properties will benefit from the cap rate compression and also increased LTV and lower borrowing costs, which means that the properties are pretty much recapitalized on acquisition. And also the sale/exit cap rate is that when Somera either lists or sells to a strategic buyer, then they will also increase or decrease the cap rate due to increased demand. And this chart is similar to the one in step 2, where we have on the left an asset that would have been purchased on a standalone basis. And we can see that it cost $8.1 million and has a cash yield of around 13%. And if Somera was to acquire the portfolio at scale, or acquire the building into a portfolio at scale, then they could see a 50 basis point cap rate compression and also have an LTV of 80% compared to 65%. This means they would only need to pay $3 million for this property, which would lead to a cash yield of 30%. But this is assuming zero increase in interest, and what would make a little more sense is around 1 or 100 basis points, which is sensitization. And we think it's going to be closer to 200, but given a 100 basis point increase in interest, we can still see that the property would still cost $3.1 million and would generate a cash yield of around 24%. So this is around a 6% decrease from 0% increase in interest. And if we see a 200% increase in interest, we can still see, like in step 2, around 18 to, or in this case, 17 to 18% cash and cash yields.
And finally, the big question that a lot of people have been asking is this strategy durable or opportunistic? So while current yields seem very opportunistic because of the highly conducive environment, we still believe that Somera can generate upward of 20% gross IRRs and teens percent plus cash on cash yields for a long period of time. As I was saying, the financing environment's very conducive. The yield curve is super cheap right now, and the triple B to 10-year treasury spreads are the widest it's been in the past few decades. And even if rates do normalize and spreads normalize by around 200 or even a bit more, you won't lose money. It's essentially you're just going to make less. But the returns are still attractive regardless of the interest rate environments, unless something incredible happens and it goes to like 1,000. But it is difficult to predict exit cap rates, and Somera doesn't claim to believe they can predict exit cap rates. So to mitigate this risk, they just dish out capital as quickly as possible and try to return it. So reducing equity exposure and reducing their downside risk. So you only make less money if something like that happens, not lose any of yours. And Somera does this on all of their strategies. They're in general a very equity-light firm that loves to de-risk by just dishing equity back to the investors.
And Lucas, in closing, how many years do you think they will take to return capital?
Oh, and they should take roughly 3 years, probably less, as it's looking right now, to return all the original equity back to the investors.
Great. With that, that's the end of the formal presentation. If there are any questions, please feel free to put them in the chat box or just unmute.
Let's cut the recording.
I'm sorry?
We'll cut the recording.
Oh, yeah. I don't know how to do that while we're in the midst of the stream of it. We'll continue it for now anyway. Lucas and Derek, do you also want to quickly comment on what they've done to mitigate interest rate movements in the next few years, even while they're variable?
So Somera has purchased some interest rate caps. So they've paid for, I think, a 1-year interest rate protection of, I believe, around 100 basis points on the LIBOR. So that'll protect them if interest rates somehow spike like crazy over the next year or so, and they'll probably continue to buy some of those.
Perfect. Can you also comment on some of the deals that we've seen? The deal activity even subsequent to the start of this analysis. How are they progressing towards scale?
Oh yeah. So the chart that I showed for step 2 before, that is data from around a month ago, I believe. And since then, that's actual Somera data. The step 3 one is not. So this is from around a month ago. Since then, I think they've done around like 3 or 4 new acquisitions, and their portfolio value has increased around like 40 million, I believe, somewhere around there.
Great. Are there any general questions from anyone in the audience?
I think also to add on to what Lucas said, that the portfolio is worth like around 40 million plus that 190, so about 230 million at the moment. So they're at or pretty close to getting to scale and putting the step 2 strategy into effect.
Plus their extensive pipeline as well, which they're working to close more deals.
Ken, did you have a question?
I've got several, but I'll start with just saying, Lucas and Derek, that's just unbelievable. Thanks.
Thank you.
Can I just pause for a minute? And Derek and Lucas, it's one of the most profound parts of this is, and it took us a few attempts to fully understand this. The whole secret sauce here is equity recapitalization. Lucas and Derek, do you want to re-explain this again? Because this is the secret sauce of the entire strategy, right? It's almost, there's there's two parts of this that were truly blew our mind. Do you want to just quickly slow down and explain that concept again? Because this, frankly, when it works, is the wizardry of real estate at its absolute essence.
Okay, so well, the definition of equity recapitalization is just when they get more debt and they pull out the equity again. So by doing that, well, that happens when they switch from 65 to 80% LTV, because that will allow you to remove a ton of the equity, 61%. And two, that will continue to happen as they reincorporate more assets into their portfolio, because the more assets you add, the equity increases, but the debt doesn't. So if you want to maintain that 80% LTV, you have to recapitalize. And what happens with that recapitalized money is they have the chance to either reinvest it into more acquisitions, and that will increase the value of the portfolio. So that will boost the MOIC, the multiple uninvested capital, or they could just send it back to the investors as a dividend check, and that will serve as like a de-risking almost.
And just to bring those numbers alive, Lucas, can you share in this example in your first work, how much capital would be returned on that first step two?
40.5 million.
Or what percentage of equity?
60%.
About 60% of equity would be returned. So it's a very, very substantial event in the life of this fund, is when they hit scale. Those three factors would return an enormous amount of capital. And would you still own, how much of the asset would you still own, Lucas?
All of it.
All of it. We have a question here from May in the chat box. Derek and Lucas, can you comment on where these properties are located? And can you share a little bit about the profile of the tenants?
So I believe they search for properties. They search for like first tier properties in third tier cities or third tier location. And the typical profile of their tenant is big industrial companies that have either investment grade credit or close to investment grade credit, or reliable private equity backing. And these properties are, of course, mission critical industrial assets. And the definition of that is these are properties that company would not be able to function without, so they can't just like up and move.
Derek and Lucas, we have another question here on parent sponsorship of the credit. Can you comment on the assets that you know of, on the parent level support or the private equity sponsored support? How do those lease obligations extend beyond just the tenant, to your knowledge?
Yeah, so from what I know, I think for most of the properties, if the company that the tenant if the tenant leaves or the building pretty much, there's no real repercussion to the private equity firm. So they don't have, or the private equity firm doesn't have too much of an obligation to keep the tenant company running. So that's one of the issues with the credit of these private equity backed companies.
I believe there are only 2 private equity sponsored properties in there, right? Actually, I think that's 3. I think
it's
one
3.
of them has 2.
That's right. That's right. There's 3 private equity sponsored obligations. And yeah, sorry, do you want to comment on how that's different from the non-private equity sponsors in this portfolio, Lucas?
In terms of
what other recourse does Somera have? Is there parent guarantees on some of these?
I believe there are parent guarantees on a couple of them. I'm not sure about all of them.
Can you remember what percentage of the portfolio is investment grade?
I'm not sure anymore. I believe it was like around 40% like a month ago.
That's right. Derek, also, before we get into further on this, can you just reiterate what a triple net lease? What's the triple?
Triple is, so 3 things: insurance, maintenance, and the last one
OpEx.
was taxes.
Okay.
And can you, the big bogey in the room is inflation. and inflation on the impact on the interest rates. Lucas and Derek, do you want to comment on how this portfolio will fare if inflation flares up? Can you walk through your thoughts?
Yeah,
So-
so you
You,
want
you,
to take it or I'll go?
no, you can go first.
All right, so one way that Somera has been kind of hedging the interest rate risk is through rent escalators. So the rent escalators are pretty substantial. It's about 1 to 2% a year. So that's their main way of kind of protecting themselves against interest rate risk. And also, if interest rates were to go up, as we showed earlier in the models, it still won't affect their yields too much because, I mean, it will affect it quite substantially, but they're still going to generate a lot of money with this strategy.
Also, another protector of like if there's like a crisis or something is their like rapid redistribution of cash. So they're like before year 3, all original equity should be returned. So unless if something happens after that, the investors will lose nothing and the company will lose. You'll lose no money. You'll essentially just make less money if the interest rates go crazy.